10-year delay in starting to invest costs the average person £620,000. That is not a typo. That is Rule 10 on this list. And if you stay until the end, you'll understand exactly why your 20s are the most valuable financial asset you will ever have, even if you're earning almost nothing. Right, so here's what this video is. 10 rules of money that the UK school system never taught you. And I know that sounds like something you've seen 100 times before, but what I'm about to show you isn't a list of tips. These are the actual structural rules that separate people who quietly build wealth from people who earn good money and still feel broke. 75% of UK adults consider themselves financially literate, yet 29% don't know how a savings account works, and only 32% can correctly calculate compound interest. That gap isn't an accident. It's what happens when you spend 13 years in education and never once sit down and learn how money actually functions. We're going to fix that right now. Rule 1. Your income is not your wealth. The gap between them is. Most people think earning more money is the answer. Get a better job, get a pay rise, earn more, and everything sorts itself out. But here's the thing. The highest earners in the country are not automatically the wealthiest people. The people building real wealth are the ones with the biggest gap between what comes in and what goes out. Income is the river. Wealth is the reservoir. Your goal isn't to make the river flow faster. It's to actually build the reservoir. Because if the river just flows straight through and out the other side, it doesn't matter how fast it's moving. You end up with nothing to show for it. Rule 2. Compound interest is the only financial force that works for you while you sleep. Rule 2 is the engine behind Rule 10, the one I mentioned at the very start. Once you understand this, that £620,000 number will make complete sense. Only 32% of people who consider themselves financially literate can correctly calculate compound interest on £1,000 invested at a 5% annual rate. Think about that. Nearly 7 in 10 people who believe they understand money cannot do the most basic compound interest calculation. And that gap is costing them a fortune. Because here's what compound interest actually does. £10,000 invested at 8% average annual return, roughly the long-run FTSE 100 total return, becomes £21,589 in 10 years, £46,610 in 20 years, and over £100,000 in 30 years. You don't add money. You don't do anything clever. You just don't interrupt it. The school system never showed you this. This rule alone, understood at 22 instead of 42, is worth more than any pay rise you'll ever receive. Rule 3. Lifestyle inflation is the silent killer of wealth. Every time income goes up, spending tends to follow. A bigger flat, a newer car, nicer restaurants, more holidays. It feels like a reward, and to be fair, some of it is. But the primary reason people earning £60,000 a year can feel just as financially stressed as people earning £30,000 is because their spending scaled up right alongside their income. The rule that actually works. Every time your income increases, save at least half of the increase before you let your lifestyle adjust. The other half can go on enjoying life. That one habit, practiced consistently, is what separates the people who build wealth from the people who wonder where their money went. Rule 4. Tax is the biggest expense of your life. Reducing it legally is the most valuable financial skill you can learn. The average UK worker earning £35,000 pays approximately £7,486 in income tax and £2,192 in national insurance annually. And that's before VAT on everything you buy, council tax, fuel duty, and everything else layered on top. Tax is the single largest cost in most people's financial lives. And the tools to reduce it legally are available to everyone. ISAs, SIPPs, salary sacrifice, marriage allowance, tax-free childcare. Most people use none of them. That's not a moral failing, it's an information gap. And now you know the gap exists. Rule 5. Debt is not created equal. One type builds wealth, the other destroys it. Wealthy people use debt all the time. What they almost never do is use it to buy things that go down in value. There are two categories. Productive debt, a mortgage on a property that appreciates, a business loan that generates returns higher than the interest rate, and destructive debt, which is credit cards, car finance, buy now, pay later on consumer goods. According to Bank of England data, the average UK credit card interest rate sits at around 22 to 25% APR. No asset you can buy with that card appreciates at 22% a year. On a £1,400 balance with a typical minimum payment, it can take over a decade to clear the debt entirely. The rule isn't avoid debt. The rule is never borrow at a rate higher than your expected return on the asset you're buying. Rule 6. An emergency fund isn't optional. It's what stops every other financial plan from collapsing. 1 in 6 UK adults, around 8.9 million people, have no savings at all. And here's why that matters so much. Every financial plan, investing, pension contributions, paying off debt, falls apart the moment an unexpected cost hits and there's no buffer. UK households face a £7,443 emergency savings shortfall because unexpected bills average £10,996, and the average savings pot is just £3,553. That gap gets filled with high-interest debt, which then takes months or years to clear, destroying everything you were trying to build. The emergency fund is not a savings goal. It is the foundation without which no other financial goal is achievable. If you're finding this useful, hit subscribe, because we cover this every week, and the next video goes even deeper on how to build this financial foundation from scratch. Drop a comment below telling me which rule you'd never heard before. I read every single one. Rule 7. Your pension is the most tax-efficient investment you will ever make, and most people treat it like junk mail. For every £80 a basic rate taxpayer puts into a pension, the government adds £20. That's an instant 25% return before the money has done anything. Higher rate taxpayers get an immediate 67% return on their contribution. No ISA, no investment account, no property deal will ever guarantee you an instant return like that. And yet 15 million UK adults are not saving enough into their pension to retire adequately. And just 4% of self-employed workers contribute to a pension at all. The school system never explained that your pension is essentially free money from the government. The rule: always contribute at least enough to get the maximum employer match, then go further if you can. Rule 8. The price of something is what you pay. The cost of something is what you give up to have it. And those two numbers are never the same. This is opportunity cost, and it is the most underused concept in personal finance. Every pound you spend is a pound that cannot compound. A £5 daily coffee habit costs £1,825 a year. Invested at 8% over 30 years, that's roughly £224,000. Not because the coffee is expensive, but because of what that money could have become. This isn't about cutting everything enjoyable from your life. It's about making the trade consciously. Most people make that trade every single day without ever realizing they're making it. The rule: you don't have to give up anything, you just have to choose deliberately. Rule 9. Your home is not an investment. It is the most expensive thing you will ever consume. I know that's a hard one to hear in a country where property is practically a religion. And yes, average UK house prices have risen significantly over the past 30 years. But your primary residence generates no income, costs you in mortgage interest, maintenance, insurance, council tax, and stamp duty, and you can never sell it without immediately needing to buy another one. The actual investment is a buy-to-let, A-R-E-I-T, something that generates a cash return. Your home is shelter. Treating it as your retirement plan is how millions of people ended up asset-rich, cash-poor, and unable to fund a comfortable retirement without selling the roof over their head. None of this means don't buy a home. Home ownership has real value in stability, security, and inflation protection on your housing costs. It just means don't count it as your retirement fund, because the day you need to liquidate it is the day you also need somewhere to live. Rule 10. The most expensive financial mistake you will ever make is starting late. Time is the one thing money cannot buy back. Here's the number in full. A 25-year-old who invests £300 a month at 8% annual return will have approximately £1.06 million by age 65. A 35-year-old doing the exact same thing, same amount, same return, will have £440,000. Same money, same rate. A 10-year delay costs £620,000. The school system taught you algebra and the French Revolution. It did not teach you that your 20s are worth more financially than any other decade of your life. Not because you earn more, but because compound interest has the longest runway. Every year you wait costs more than the year before. So here's where we are. Your income is not your wealth. The gap between them is. Compound interest is the most powerful financial force available to you, and only 32% of people who consider themselves financially literate can even calculate it correctly. Lifestyle inflation silently erodes every pay rise. Tax is your biggest expense, and most people do nothing to reduce it legally. Debt is a tool, but only when the return beats the rate. Your emergency fund is the foundation everything else rests on. Your pension is free money most people are leaving on the table. Opportunity cost is invisible until you learn to see it. Your home is shelter, not a retirement fund. And time. Time is the one variable you cannot get back. You came into this video knowing school never taught you this stuff. You're leaving it knowing why that gap was so expensive and exactly what fills it. The question now is what you do next. If you want to see all the other traps quietly costing UK adults money right now, the video right here covers 7 of them in detail. Watch that one next. It picks up exactly where this leaves off.